Chapter 5, Deductions for and from AGI. Today, we're covering Learning Objective 5.8, Applying the Rules for an Individual's Taxpayer's Interest Deduction. This is also a deduction that is allowed as a Schedule A itemized deduction. Taxpayers are allowed a deduction for certain interest paid or accrued during the tax year. Interest is defined as amounts paid for the use of borrowed funds. The borrower must be legally liable for the note in order to deduct the interest. No deduction is allowed for payments made for another's obligation if the taxpayer is not liable for payment. Examples of deductible interest include qualified mortgage interest and points, mortgage interest prepayment penalties, investment interest, unless it's used to generate tax-exempt interest, and certain interests associated with passive activities. Interest on other loans for personal purposes, which do not fall into one of the above categories, is generally referred to as consumer interest and is not deductible. Consumer interest includes interest on any loan, the proceeds of which are used for personal purposes, such as credit card interest, finance charges, and automobile loan interest. Mortgage interest. Qualified residence mortgage interest on mortgage is interest that is deductible if you use it to secure or build a first or second home limited to loans up to $750,000. You can use the loan to build your primary house and your second home, but the loans can only be up to $750,000. Unless the home was purchased before December 15, 2017, then you can deduct home mortgage interest on debt up to $1 million. In the past, home equity loans could be deductible, but you are not allowed to deduct them now. Private mortgage insurance was deductible before the TCJA, and it is no longer allowed now. PMI is something that many lenders require home mortgage or borrowers to purchase. So this may or may not be applicable. And then a home equity, a line of credit on a home. You used to take the interest on your home equity loan, but you're no longer able to do so. Loan origination fees, also called points, because they're quoted as a percentage point of the principal amount, are fully deductible. If it is made for the purchase or improvement of a personal residence, then you may deduct them fully in the year in which they are paid. Points paid to refinance a home are not deductible when paid, but have to be capitalized and deducted over the life of the loan. So as you all know or have heard, I purchased a new house this January. Points that I paid on the purchase of my new house would be fully deductible on my 2020 tax return. Let's say 5 years down the road, I decide I want to refinance my mortgage because rates have dropped. Points that I pay for the refinance are not fully deductible that year. They'll be deductible over the lifespan of the loan. Education loan expenses. Taxpayers are allowed a deduction for adjusted gross income. This is an above-the-line deduction. Education loan interest does not show up on the Schedule A. This shows up above the line above AGI. This is like those educator expenses. You're allowed up to $2,500 per year, but it phases out once you reach a certain income level. If you're single, the phase out starts at $65,000 and ends at $80,000. So if you make over $80,000, then you cannot deduct any education loan interest. The phase out for married filing joint is $130,000 to $165,000. So as long as the two of you have an AGI of less than $130,000, you can deduct all educational loan interest up to $2,500. Once you reach $130,000, the phase out begins, and once you get to $165,000, no deduction is allowed. The loan must be used for qualified higher education expenses. This includes tuition, room and board, and related expenses. Investment interest. Investment interest is incurred on debt used to purchase investment property. Investment interest deduction is limited to the taxpayer's net investment income. Net investment income is income such as dividends and interest, less any expenses you have other than interest. So you can only deduct investment interest up to your net investment income. Any interest that is over that income, you may carry forward to the next year and is reported on Form 4952.